Okay, we're gonna start it up again. We're gonna switch over to resident tax. So I am going to be completely honest. We've got a lot of material to cover. So I will do my best to get us done here by the 8 o'clock to 8:15-ish, so like a little over an hour. We might go a little bit long, so I may skip a few of the examples or anything like that. This is the longest one for whatever it's worth. So if you make it through this one, you can make it through anything. All right, here we go. We're gonna do income, adjustments, deductions, and TaxSlayer Practice Lab. All right, I didn't even update that, never mind. Okay, so for income. So again, we're gonna cover a lot of material. So I am going to hit on a high level for a lot of income topics, okay? One of the great advantages of the resident software and the resident taxes in general, right, is that everything is really designed for it. So generally, if a taxpayer has that type of income, very often there is a form that reports that kind of income. And there is a spot in the software where you can enter that kind of income. And it all just works, which is fantastic. Which doesn't necessarily happen for non-residents, but it generally does for residents. So, and the other part of it is that for our tax clinics, because we are primarily focused on students, scholars, teachers, researchers, we generally see relatively simple and straightforward returns. There are a couple of areas where we spend a lot of time, like scholarships and dependency, because we have students that are in those situations. But we do not see a lot of retired individuals or necessarily self-employed individuals. So when we go through our training, I will touch on all of those things so that you have at least some awareness of them, but I will not dive into really deep depths about taxation of Social Security benefits and things like that. All right. So the other thing that I want to say is that generally, right, the software works. Currently, the software is not going to work because they're in the process of updating it for 2024. So the forms are not finalized. They've not been released by the IRS. The software is not finalized. They're in the process of doing that, but there are mistakes that happen in the software. By the time we get to the actual tax season, it will be good because lots of volunteers like you and a lot of people at the tax software companies go through to validate everything. But for right now, when we use the software, when we use that TaxSlayer Practice Lab, know that you can't trust it 100% for 2024 yet. It may not be good. So if you think you see something that you're not sure about, do some more investigation, check into it further, go into that 4012 because it may or may not be that there is a problem in the software. Under some circumstances, we will have types of income that are not going to be reported on any kind of a document. Usually in that case, as long as it seems reasonable, we're going to take the client's word for it, right? We're going to believe a $50 contribution to a charity. We probably won't believe a $50,000 contribution to a charity. That kind of person that can give that money probably doesn't belong at a VITA tax clinic. If it's something like that, though, we don't need to see that documentation. And often the IRS is not going to ask for that documentation up front, but the person should have that documentation so that if the IRS does send them a letter, they can say, yes, by the way, I did really give $50,000. It was because I gave this car. It was fabulous. I thought it was a junker. Turns out I was wrong. That kind of thing. Okay. Same general tax question. Or equation, pardon me, we've already seen that. Here is the shenanigans for income. Look at all these types of income. Holy buckets. But number one, right, again, most of these types of income, they're all going to have their own income document, and the tax software is going to help us. And then a bunch of those also are going to be out of scope. We're not going to have to worry about it. So for the income, this is the section on the form 1040 that reports all of these different types of income, right? We talk about wages, tips, Medicaid, dependent care benefits, other types of income, interest, dividend, so on and so forth. So let's go through that. So from the IRS perspective, right, gross income is all income received in the form of money, goods, property, and services that is not exempt from tax. For residents, right, includes everything in the world. They don't care where the money comes from, they want some of it. It includes when you sell things, including if you sell a house. It can also include your retirement benefits, such as Social Security benefits. It also can include some scholarships, fellowships. Income that is subject to tax must be reported on a taxpayer's return. Income that is non-taxable still may need to get reported on a tax return, even if you don't have to pay any tax on it. Sometimes it doesn't, sometimes it does. It just depends on the type of income. All right, earned income is income that you receive for work, such as wages, or if you have your own business and you sell goods or you sell your services. Unearned income is income where you don't have to do anything to earn it, such as interest, dividends, stock sales. If you had a rental property, right, those people give you money. It doesn't matter if you sleep in all day, you're going to still get the same amount of money. Unless there is a specific exception in the tax law, the general rule you can go with is if you have income, it's going to be taxable. It's just kind of a simple rule. All right, here's a really big list from the 4012 of all the different types of things that the IRS considers income. We're not going to go through, well, we're going to talk about a bunch of them, at least in a high level detail, and some of them in more detail. Again, this is the form W-2. Same form is used for residents and non-residents, right? Doesn't matter, still going to report your wages. The big difference here is that residents are also going to be paying usually Social Security taxes and Medicare taxes. So old age retirement income, old age government insurance, medical insurance. If you are working at some types of jobs, you may receive tip income as well. Sometimes those are going to be reported on your W-2 as well. Sometimes they are not going to be reported. Remember, even if you're getting income as cash, the IRS still wants you to pay your income tax on it. So you are supposed to report that income as taxable income. Scholarships and fellowships that get reported on a W-2, we'll talk about that when we get to education benefits. That's going to be somebody that's got a quote scholarship, they have to work for it. When you have wages, salaries, and tips, whatever, you're going to enter the information from, well, not you. The clients are going to enter the information from their W-2 form, right? Very straightforward. The entry on the software looks like, for the most part, sort of the W-2 form itself. All of that information is going to be entered. It's going to flow through the tax return properly. If there are tips, and if they have unreported tip income, there is a special form for that. I will say that a lot. There is a special form for that. That's going to be on form 4137. That's going to get reported on schedule 2. What should a student do? Thank you, Mr. Jeff. They should email us because so non-resident aliens don't have to pay Social Security and Medicare taxes. We didn't get to that yet. We'll talk about that next time. But they don't have to pay them. But sometimes employers will take those out by mistake. Those students can get them back, and we help them do that. We will help them write a letter to their employer saying, please give me the money back. You shouldn't have taken it away. And if their employer says, no, I don't care, we're not going to give it to you, then we will help them fill out the forms and get the money back from the IRS. We do that work over the summer. We don't do it in the middle of the tax season because things are very busy and very crazy then. But we will send a note to all of our volunteers saying, hey, We're looking for volunteers to help with this. If you're interested, there's like a very quick Moodle course that we do in May. If you see any clients with this situation during the tax clinic, you're going to have them contact us. We basically have a list of all of the people. And then after the semester ends, we start reaching out to them. Hey, you reached out to us. Is this still the case? So we want to do that. All right. Yeah, so non-resident alien students don't have to pay FICA tax or Medicare taxes. Students, scholars, teachers, researchers, if they become residents, they do have to pay those taxes. So it does change over time. It does change over time. All right, bye, Will, thank you. Okay, thank you, Mr. Jeff, for asking that question. All right, back to tips. If we have anybody with tips, they need to get reported. There's a special form for that. That's like the IRS mantra. Yes, you have to pay income tax on it. There's a special form for it. If you work as a household employee, such as babysitting or housekeeping, that may not get reported on a W-2, but you also have to report it. Other benefits may need to get reported, like adoption benefits, dependent care benefits, retirement income that was not properly deferred could be reported, non-taxable combat pay if we had any military vets that came to see us to get their taxes done, that would also get reported as well. Moving on to interest, right? So most interest is going to be taxable. It's going to be reported on this form 1099 INT. All right, some interest is by law non-taxable. The 1099 INT form can look different depending on who's providing it. So this is like the standalone form. A bank might send a form that looks like this. If somebody has an investment account, it would look like this, where it's just the form number and then they have the lines from the appropriate information. So, and they would report general interest income on this. They will also report tax exempt interest. So general interest is going to be like checkings and savings, interest on insurance dividends, US government bonds. If there is tax exempt interest, that's also going to get reported, but that's not going to be common for us. And in truth, it's not very common for there to be a lot of interest. The one exception that we do see, though, is that if a bank runs a deal, open a checking account with us, open a credit card with us, we'll give you $100 bonus. That is usually reported as interest on a 1099 INT. And so we will see 1099 INTs for that relatively frequently. But that's generally the only time we'll see that. If they happen to have interest over $1,500, the tax software will automatically add a special form for that called the Schedule B. If it's less than $10, the bank won't even send a form. Again, they're still supposed to report it, but there won't be a form that they will have. All right. Generally, we're not going to see much tax exempt interest. That's usually going to be things like the state of Minnesota is raising money to build a new bridge. And so they issue bonds. They say, oh, we'll give you, 5% interest and you don't have to pay tax on it. Hey, great, I'll give you the money for that. It's going to be reported on line 2A of the 1040. Check 4012 if you have it, but it should be on the 1099 INT. If we have anybody in that situation, it would be quite unusual. Dividends. You buy stock in a company, the company makes a lot of money. They say, we love our shareholders. Here's 10 cents for every share you own. They will report that as a dividend. They will send you a 1099 DIV form that says, here's how much we gave you in dividends. Again, that's going to be different forms based on organization. If it is a brokerage account, they will usually consolidate all of it to one number. Say, okay, yes, you got $1,000 of dividends because you owned Apple and semiconductor manufacturing companies and all that kind of good stuff. Qualified dividends are a type of dividend where you get special tax treatment. The special type basically means that you have held it for long enough. Usually that's about a year. The company that you have that holds your stock for you is going to know that because they will know when you bought it and when you sold it. If you sold it, when those dividends were issued, they will report those amounts to you. The advantage of this, the idea, right? The not buying and selling all of this stuff. You buy the stock, you hold on to it for a long time. That gets you a lower tax rate than you would otherwise have to pay. Capital gains, right? You buy something, then you sell it for more than you paid for it, then you have to report that as income. For residents, it gets reported on a Schedule D. The software should do that for people automatically. They have a capital gain distribution on a 1099 div or even on a stock transaction. Retirement income, not very common, but again, there is a form for that. This is right. This is the mantra. The IRS has forms to report all of these types of income. The people that give the money, they fill out this form. They send a copy to the IRS. They send a copy to you. The IRS matches to make sure everything is good. For an IRA or a distribution, there will be information about like how much money did they give you, gross distribution, the total amount that you got. There will be a spot for a taxable amount if that's calculated, or they can say that it's not calculated. We don't really know. They'll say if it's all been distributed, they gave you everything that you had. Was there any federal tax withheld? Why did they take the money out, right? The idea for this is that, right, is if you save for retirement, the government loves that idea. They will give you a deal on that. You can pay less tax or not have to pay any income tax on the money that you save for retirement. When you take it out, then you're going to have to pay tax on that money. Because the idea was for this to be a retirement income, if you take it out too soon, like before you reach a target age, they're going to say, this was supposed to be for retirement. We're going to make you pay a penalty on that to encourage people to leave that money in there for retirement. There will be information about distribution codes because there will be things like, okay, yes, I'm not old enough, so I should pay the penalty, but I lived in a disaster zone or I had medical expenses. So those are really good reasons. Okay, those are okay reasons. You don't have to pay the penalty. So you can see that whole layering of government rules. This is a prime example of where it's just become quite complex. The good news for us generally, number one, we're not going to see a lot of them. And number two, a lot of the information we would need is going to come to us on the form in terms of the distribution amounts, the distribution codes, and then, you could talk with the client to understand, hey, I see you had a retirement distribution. Was there something in your life that happened that made you need that money? All right. I think I probably just talked about basically all of this without even going there. Distribution codes. All right, Social Security benefits. If you are here in the US and you work long enough, you can retire and get Social Security benefits. A portion of those can be taxable based on your total income. It's the easiest way to say. This is what that form looks like. Obviously, this is a very old one, but that's what that form looks like. So if the clients pay for Medicare, so old age medical insurance out of their Social Security benefits, that will show up on that form as well. You can enter that again into the software. That will do all of the work to calculate how much tax you owe. Generally, it's going to be 1/2 of the benefits if you meet a certain income amount, but it will also depend on your filing status as well. All right, software. Software is the best. Software is the best. All right, capital gains. I mentioned this before previously, right? So you sell something for more than you got, you make some money on it, that is considered a capital gain. You have to report that on Form 8949 in Schedule T. Based on how long you held that item, you will have different tax treatment. Just like that dividend with the qualified dividends or not, you could have a short-term capital gain, which is less than a year, or a long-term capital gain, which means you've held it for a year or more. Transactions involving digital assets. So cryptocurrency, virtual currency, NFTs, all that kind of stuff. Those are considered assets, even if they are a virtual asset. Those are out of scope for the VITA program. The software doesn't care what type of asset it is. It just enters all of the assets. But we can't provide any guidance about how to do that. All right, we've got some reference information, some links to IRS website pages that we can send people to that talk about how people should report those transactions. We can give those to them, let them look at those, figure out how to do it. So, all right, there's the holding period, 1 year, less than 1 year. All right. For most stock transactions or capital gains transactions, especially from a brokerage, the brokerage itself will track what did you buy it for, what did you sell it for, how much money did you make or not. So we generally don't have to do any of that math, or the clients don't have to do that math. It's kind of already done for them. Residents do have this one nice little thing, right? You're trading stocks, you do not do a good job at it. You lose money. If you lose, you can lose up to $3,000 in capital gains and subtract that from your income. So let's say you had wages of $20,000 and you lost $1,000 trying to time the market for this one stock. You will report that information and you're only going to have to pay tax on $19,000. That is only for residents. Non-resident aliens do not get to do that. If by chance things go really, really badly and you lose more than $3,000, you can carry that extra over to the next year. You can carry it over to the next year and so on and so forth. Hopefully we will have nobody that is in that situation. All right, so general review. So the first section on the 1040 is for income. Wages, salaries, and tips reported on a W-2. Interest, dividends, capital gains, retirement income, Social Security. We're only doing advanced certification level here, so you get all of this stuff here. We don't need to worry about only the certain things that only basic level certification can do. We do see capital gains at our tax clinics. So there are definitely people out there that are trading. So those are the very common types of income. The IRS has Schedule 1, which is basically, think of it as the miscellaneous list of all of these other types of income. And then here's the big list. So generally, again, right, if you have other types of income, you will have some sort of a form that it gets reported on. You'll enter that form into the software. It will automatically flow onto Schedule 1, and it'll automatically flow onto your 1040 return. We do see two things here that are relatively common. So taxable refunds, we do see those there. Those show up on Schedule 1, mostly for non-residents, but we can still see them for residents sometimes. And then the big one is scholarships. Taxable scholarships show up on Schedule 1. So we'll see that there. We're going to talk about that in more detail under the education benefits section, which is going to be next week. But we'll talk about this that's where it goes. This is what that form looks like. I know it's very small. It's because it's a very big list of all of these miscellaneous types of income. All right. We talked about this before, right? That same idea. You itemized, you subtracted your state tax, but then you got a refund of some portion. Now you need to add that amount of that refund back as your income on your tax return the next year. Theoretically, a lot of residents should receive a Form 1099-G that reports a state or local income tax refund. Minnesota does not send one of those forms out. So if you go online, you can try to download a copy of that, but we don't need the form. We just, if they have their return from last year, they can see what their information was. They can also go to their bank account, look at their, hopefully their automatic deposit. It'll say like Minnesota Department of the Revenue. It'll show what their refund was. All right. Alimony received. So if a couple is married, they get divorced, and there is a court-ordered provision that says one spouse, former spouse, needs to give the other spouse money. Prior to 2018, that could be reported as income for the spouse that's receiving it, and an adjustment for the spouse that was paying it. Everything else after that doesn't need to be included. However, for the alimony received, you have to put the date of the divorce decree if you ever have to enter that in the Schedule 1. All right, so this is definitely not a common situation, but could theoretically show up either in our tax clinics or on the IRS test. Business income. So business income is absolutely advanced level certification. Basically, it is a Schedule C is the form that goes on. You report your income first. It can be on a couple of forms. It could be on a 1099 NEC. It could be on a 1099K, which is like a credit card processor. So if you are selling stuff on Etsy, then you use them to process or use Stripe to process all of your payments. You would get a 1099K from Stripe that says, congratulations, you sold, $6,000 worth of really warm hats to keep everybody from freezing to death in the Minnesota winters. You would need to use whatever other books or records you keep as well to report other types of income. This is where that cash business income from Edna and Joe's example comes in, right? Lots of businesses use cash. That's totally fine. It's not illegal to use cash. You just need to report all of your income. As a side fun note, the US federal government has a history for when people are engaged in criminal conduct and they can't catch them doing the naughty things there, they will go after them for tax evasion. So think Al Capone back in Prohibition years, bootlegging liquor. He did not go to jail for selling alcohol. He went to jail for not reporting it on his taxes. So not that we have anybody that does anything like that at all. But just to say that the IRS does take not reporting all of your income very seriously. That's like one of the things that will get them the most excited about any kinds of naughtiness. All right, so other gains or losses. If you sold or exchanged items used in a business, something like that, totally out of scope for us, but that's where it would go. Rental real estate, that's all going to be out of scope for us. There's a small exception for military certification for military families when they are like changing their duty station and they rent their former home, but we're not covering any of that. It is completely out of scope for all of us. Farm income is also reported. Farm income is out of scope for us as well. Unemployment compensation. So, right, you were working for a company, everything was great. The company had a layoff, right? Things were not going well for them. You go report that to usually there's a state unemployment commission. You can get unemployment payments while you're looking for a new job. Anybody that had this should get a 1099-G that's going to report that unemployment compensation. All right, this only happens when you get laid off. This does not happen when you quit. So they will send you at least a small amount of money to help tide you over till you find the new job. If somebody thinks that the amount is not right, we cannot fix it for them. We can't fix any of these income documents, right? And the IRS has these income documents. So ideally, we really want the numbers to match. The best thing for them to do if something doesn't match is to go back to whoever gave them that money and try to fix it there. And we do have that occasionally happen, especially on like a non-resident with a 1042-S form. Those things do occasionally happen, but it's not very common. But if they send a return in where it doesn't match, that is where generally slows things down. Refunds can take a very long time because the IRS will send a letter saying, you know, we don't think you should get this money back because your numbers don't match what we have. And then you go from there to try to fix the situation. All right, this is the list of other income. Line 8R is the one that we're going to see, scholarships, fellowship grants, not reported on a W-2. Theoretically, there could be other things, gambling income, jury duty, cancellation of debt. Not common. If we ever do have anything like that, again, there's a form for that. Clients should be entering that form information in there. The 4012 is a beast for a reason, right? Because it does have more information about all of those types of income. So if you ever have a question about that, in the tax clinic, we're always going to have those available in person or electronically. Look back to that as your first source. If you don't see what you want to find there, irs.gov, type the type of income in, type whatever type of form it is in. There'll be information about that there as well. All right. More other income. Basically, lots and lots of income types. Get more income. All right. We do occasionally see a Form 1099 miscellaneous, so I will mention that here. Usually that's going to be for somebody that wins a prize or an award, right? You entered a case competition, your proposal won a $250 award. Usually they don't provide them unless it's over $600. So you won a $1,000 award. It was great. You're awesome. You have a 1099 miscellaneous. Enter the form. It's all going to be good. This is what that form looks like. Generally, it's going to be on line number 3, other income. All right, we're not going to do that. We're not going to do that. We're not going to do that. It's all the information there. All right. So just a couple things about impact on the income on the tax return for business income. So if a payer somebody has a business income, you're going to, number one, you're going to be required to be advanced. You're going to do the Schedule C. There's a wide variety of business expenses that are allowed, right? And it's usually, they try to get the words right, it's ordinary and necessary are the 2 words that the IRS generally uses to say, is that an allowable business expense, right? So for example, if you have a business making very warm hats for people in Minnesota, fabric to make those hats is going to be a normal and ordinary business expense. A trip to Hawaii to try to sell hats is probably not, right? Because who in Hawaii really needs very warm hats? You know, there's not really necessarily a good argument for that. Possibly there could be, right? But that's where you would want to say, how does that link? How is that really necessary? Oh, well, there's a convention for warm hat people in Hawaii every year, so we can take off our hats. Fine, then that's perfectly good. All right. If you have income, a profit from that business, right? You are going to pay tax on that business income. If it is more than $400, you also are going to pay self-employment taxes, right? So when you work, you're going to pay Social Security and Medicare taxes. If you have your own business, you also still have to pay those taxes. And those taxes normally are paid half by the employee, half by the employer, the person that's hired you. If you have your own business, you have to pay both halves of those. All right. Okay. I'm going to do that. I'm going to skip on that. All right. Any questions on income? All right. Basically, almost entirely, right? The IRS doesn't care what you did to get it. They want some of it. They don't care where it came from in the world, still want some of it. But they have a form for it, so it makes life a little easier. You can use that information to enter it into the software, to find resources either in your 4012 or on like the irs.gov to help you understand if there's any special nuances about that income. All right, let's talk about adjustments here. All right, so these are things that you spent money on that the government thinks were a good idea, and they say, okay, we'll give you money off on your taxes because you spent it on these great things. All right. So when you take a total income, you subtract these adjustments, which is a set list of things. The result of that is what's called the adjusted gross income. All right. And adjustments will lower your taxable income. They'll reduce the amount of tax that you pay, but they won't lower some other types of tax, like self-employment tax, right? They're not going to reduce how much money you made on that business, how much Social Security and Medicare tax that you owe. And it's reported on Schedule 1. It's a 2-page form. The first page is all of these other types of income. Second page is all of these adjustments. And that's what it looks like. This is an old version. They only can lower your adjusted gross income down kind of dollar for dollar. So they're not like a multiplier factor. So if you have $300 of adjustments, you can take away $300 of income. So, and that's only on the income side. It's not taking away the tax part of it. It's only the income part of it. So in this example, you had educator expenses, penalties, like a whole list of things. Basically, you can add those all up and subtract that to get your adjusted gross income. These are generally not very common things for us to see, but they do have, they can happen, and some of them do happen, like on an infrequent basis. Yes.
Like penalties also calculate like adjustments.
So there's one special type of penalty, which I'll talk about in just like 2 minutes. Okay. Okay, so the educator expense. You're a teacher. We love you for being a teacher. Congratulations. You worked at least 900 hours being a teacher in K through 12, so not college teaching, which is like a lot of our people. K through 12 teacher, 900 hours. If you spend up to $300 of your own money on supplies for your classroom, you can take that off as adjustment from your taxes. If you're married and both spouses are eligible, you can be 600, right? But they both have to be eligible. You've got to work that 900 hours at least, and it's got to be ordinary and necessary expenses. And this does not qualify for homeschooling. This is only for somebody that's working as a teacher. Theoretically, maybe like somebody that's getting a master's degree in teaching and is like teaching at a school as part of that program, maybe they would hit the 900 hours, but generally we're not going to see many people that would meet that. All right. Okay. Penalty on early withdrawal. So if you have your money in a savings account, you can just take it out whenever you want. If you buy a certificate of deposit, you say, okay, for a year, you get to keep my money. I will give you extra interest because you don't have that money for a year. But if you take it out before that year, you have to pay a penalty on it, usually like 2 or 3 months of interest. That's what this penalty on early withdrawals of savings deduction is. It's the only penalty that you get to take an adjustment on. And it's going to be reported on a 1099 INT in this box number 2. Early withdrawal penalty is where it would go. The good thing for us, super straightforward, right there on the form, enter the numbers in, it'll automatically flow through to that adjustment. Again, also not a common thing, but it happened. All right. So again, we're going to use the forms, right? Even if they say, oh, that was more, I paid more than that, then they need to go talk to their bank about that, right? We can just recommend that they use the forms because that's what's going to match. All right, alimony paid again, right? This was the couple got divorced back before 2018. The one spouse gives the other spouse money every year. The one reports it as income. The other one gets to subtract it as an adjustment. There's a big long list of requirements that's included here. Generally, it's not going to be a very common thing. If you were to see somebody that had a situation like that, you're going to want to make sure that they've got copies of that divorce decree or the alimony order from the court. So just a simple promise. Yeah, I told my ex-husband that I would give him, $1,000 a month to never bother me again. That is not going to count for this. It's going to have to be a legal requirement that they do it. It also cannot be child support. So if they're required to pay money to support a child, that is separate and that is not allowable as an adjustment. All right. Retirement account. Save money, save it for retirement. If you do that, the money that you put into a traditional IRA account, you don't have to pay tax on. You can subtract that from your income as an adjustment. There are lots of limits about what your total income can be, if you're married or not, if you're covered by a retirement account or not. But generally, the idea is you can save some money, make that contribution, and not have to pay tax on it now. You'll pay tax on it in the future after it's grown to be lots and lots of money, and you can take it out then. Student loan interest. This is one that we definitely do see a few of, right? So if you took out loans to go to school and you are paying them back and you have to pay student loan interest, you can subtract up to $2,500 of that for an adjustment. You must be legally liable for that loan. Your filing status cannot be married filing separate, so that puts out most of our non-resident aliens that are married. You can't be claimed as a dependent, and you must have the form from the lending institution or be able to look up that information. Because the IRS, again, right, they're trying to match that information. There is some other adjustments as well. I'm not going to go through them. The software, again, enter the form. The software will generally enter that information correctly for you. One thing that I will talk about is healthcare savings account, right? So the idea is you have health insurance, but it doesn't cover all of your expenses. The deductible, if it's a high deductible plan, that means you've got a lot of money that you have to pay first before you can start using your insurance. You can save for that in a healthcare savings account. That money that you put into that savings account is not taxable income. It's an adjustment. You don't have to pay tax on it. Then when you take that money out, as long as it's for a qualified medical expense, you still don't have to pay any tax on it. So it's like a double whammy to try to help minimize the cost of healthcare and health expenses for individuals. There are some limits about how much you can contribute to that based on whether it is yourself only and what your age is, or if it's a family. Contributions can be made up to the filing deadline as well. So if they wanted to put some extra money in, that could happen. Usually this is something that happens as a regular withdrawal from your paycheck. You have, $25 every paycheck that goes to your healthcare savings account. All right, that's kind of what I just talked about there. Self-employment tax. So we talked about you have your own business, You have to pay FICA and Medicare taxes. However, you get a little bit of a bonus. Half of that money you can take as a subtraction or an adjustment on your tax return. So it'll still reduce your tax amount. So you still have to pay that tax, but you can subtract that from your income. So you're not paying quite as much tax on everything. There's a health insurance deduction as well. I'm not going to go over that because it's relatively uncommon, but that is there as well. Basically, if you have a business, you're making money and you are also paying for healthcare insurance for your employees, then you can have a deduction for that. I'm going to skip the knowledge check because we're almost at 8 o'clock. All right, we're back. Whoa, Maria, what do you do? I don't understand what I do there. Back here to the equations. Okay, so gross income minus adjustments equals adjusted gross income. Adjusted gross income minus deductions equals taxable income. So taxable income does not necessarily mean that the income is going to be taxed. It just means that it's reported on the 1040. Taxable income is all of these types of things. We add all of those together. We have all of our big list of adjustments, and then we have our deductions as well. Just like we talked about with the non-residents. There's the standard deduction, which is a set amount, then itemized deduction, which is a whole list of things. And then you can subtract whichever one is the largest to reduce the amount of tax that you owe. As a reminder, the exemptions, the subtraction for people is 0 right now. That's why they're not listed. So for deductions, you can always use, well, so there's 2 again. Generally, you can use the one that's higher unless you are required to itemize. The primary situation you would have in that case is if you are a married filing separate filer and one spouse itemizes, the other spouse is required to itemize as well. All right. I know that this is a lot, it's a little complicated. So here is my little very simple picture diagram of how to figure it out. You have your adjusted gross income. You can look at the standard deduction, or you can look at all of your itemized deductions. Whatever is higher, go that path down to your taxable income, right? Unless you're required to itemize. Because of the tax laws that changed back in 2018, 2017 Tax Cut and Jobs Act, most people will take the standard deduction. It is not common to itemize. Here is this chart for the standard deduction. It's in your 4012. Again, it's based on your filing status. It is based on your age. There's also an addition if you are blind as well. If somebody qualifies as a dependent, they still do get a standard deduction, sort of. It is either the greater of $1,300 if they have no earned income, $450 plus all of their earned income if that's higher, up to the standard deduction for their filing status. All right, so even a person that is a dependent still gets a standard deduction. It just is not automatically that same large amount. It might vary a little bit. It could be the same, but it might not be. All right, itemized deductions. Again, this is not very common, but it will include expenses such as medical and dental expenses, taxes paid for like state and local income taxes and property taxes, home mortgage interest, gifts to charity, and it can be some miscellaneous deductions as well. So medical expenses, the only amount that you can include is the amount that is greater than 7.5% of your adjusted gross income. So it's not just even your total medical expenses. So you say, okay, I had $10,000 of adjusted gross income. All right, so then it's going to have to be more than, is that right? $750 in medical expenses. I think that's right. I may be off on a 0 there. It includes all kinds of doctor bills, dental bills, prescriptions, hospital bills, insurance premiums if they weren't paid for, like out of pre-tax money, out of your wages, and a lot of other things. So it is a very large list of potential expenses, but generally nobody's going to hit this unless something has gone very, very, very badly for them. So usually it takes a lot of stuff to go wrong to hit that 7.5%. State taxes, so sales tax or income tax, whichever is larger, generally that's going to be sales tax now for people that are not retired or if they're in a state that doesn't have an income tax. Local or foreign taxes would generally be out of scope. We're not going to worry about those. Real estate or personal property taxes. The one other limit is that for these taxes, state and local taxes, it's limited to $10,000. So it used to be unlimited. So if you lived in somewhere like California that had property taxes through the roof and a really high income tax, you could have, $15,000, $20,000 of taxes there pretty easily. But now, because of that limitation, you're stuck at $10,000. You can't subtract any more than that. So that is one of the reasons why the standard deduction is much more common for people these days. Home mortgage interest would get reported on a 1098. So you get a loan to buy your home. The interest that you pay is a deduction, itemized deduction, if they meet that threshold. Same thing for charitable contributions. US charities only, not anywhere in the world, just US charities. There's a few miscellaneous deductions as well. Again, those are not very common. So typically we're going to see people that take the standard deduction. It's possible that they might want to take them. They can enter it, right? Enter it all into the software. There's nothing that's harmed by entering it in. Software will do the math, double check to make sure what's worth more or not. Say, we think you should do this. You can do that. All right. There we go. There we go. All right, we're going to do practice lab really quick, and then we're going to be done. All right, so I'm going to make this P big here. Do I want to do this? Yeah. Do it this way. Do it this way. Okay, so the link is right here. The link is also out in your Moodle course as well. By the way, if you want to do the resident training and you're not in the Moodle course, please make sure you've done your volunteer data questionnaire, because that's one of the questions and that's how I add you to the Moodle course. So, and I was current as of, I think like 4:30 today for everybody that submitted. So if you did and I haven't responded quite yet, I apologize and I'll get to that as soon as I can. So for non-resident taxes, because the software is not helpful, we're not going to go into the software before the IRS certification tests. However, for resident taxes, because the software is generally very helpful, even if it is not quite updated, we are going to use that software and practice it. And we're going to keep an eye out to look out for problems in the software so we can say, hey, I know that it's not doing this right. If you're trying to prepare a return that has this in it, you need to make whatever adjustments. So this is a 2-password system because it is very special. So the first one is all caps, Train Pro Web. And then you create an account. You're going to pick whatever information that you want for your email address and username. It does not need to be a school email. It can be whatever email you want to use. You're going to select VITA for the program. You can enter this 392,021. That's one of our tax VITA site numbers for the site destination, and then create an account. Then once you've done that, you can just log in like I'm gonna do here. And you're gonna be in. There we go. There are a bunch of like user guides for using the software. If you love software and you want to go mess around with them, you're very welcome to do that. Some of this stuff is based on setting up the software for a site using a traditional model, and we're not going to do that. The software that we use or that our clients are going to use is going to be very similar to this, not quite identical, but it's going to look very similar. But it's not going to have some of this functionality where you can have like multiple clients, multiple people, because the software is essentially a single use. You log in, it's your name, it's your return. You can't create another return. Whereas in the practice lab and in the software for traditional clinics, right, you're going to have lots of clients, you're going to have lots of returns. So when we want to come create a return, we would start a new return. We will enter a fake social security number. This system is not live. You cannot file a real return for anybody. When we use the FSA software, that is live. There's no non-live version. And you can file a real return. So you want to be careful. But for this, we're going to just make it up. So they have to make sure they match. You're going to use the basic, start a return. And it should give me the warning message saying, hey, we're not sure, it's not right. Yes, we know that it's not good yet. And then we start with filing status. And we go from there. Yes.
What's the size now?
Yes, it is 392,021. All right. So when we do tax returns, we're gonna do this. So I think, did I have it in here? All right, I did. All right, so I'm gonna do a very simple return. Really quickly. Jacob Miller. He is a sophomore studying at App State. He is single. He was born on January 1st, 2003, because I'm lazy. He is a US citizen. His parents live in Charlotte, North Carolina. His parents are paying for his school tuition, his room, and his board. They are claiming Jacob as a dependent on his tax return, but he worked on campus so that he could have some spending money. All right, so Jacob received a W-2 from his on-campus job at App State. He earned $5,200. So we're gonna do a really quick return just so you can see how it goes. Jacob is single. Jacob Miller, 01/01/2003. He is a student. He can be claimed as somebody on another person's return, and he will be claimed. So he could be claimed, and he is going to be claimed. He's over 18 and he's a student. He is not blind. He is not dead. He does not want to contribute to the election fund. None of these things. We're going to say no on the natural disaster, even though Jacob really probably could be saying yes to that. Address 32 Home Drive, 28608. It looks up the address for us, which is fabulous. With the phone number, which we will make up. We'll continue. All right. To be eligible to claim, you must be, okay. Yeah, it's basically saying, hey, you can't claim any dependents because you're being claimed as a dependent. That's fine. All right, here we go. We're going to enter his W-2. 56, 117, 60, 30. There's app states information. 200, 180. It does the math automatically on the Social Security and Medicare. It doesn't have anything checked here. He pays state tax. $90. There we go. Continue. All right. He doesn't have any of these things, right? He has no business. He has no rental properties. He's got no farm. He's got nothing. He doesn't have any adjustments. We'll say it says standard deduction is the way to go. We don't have any itemized deductions, right? Nothing to put in here. We haven't talked about any credits, but we'll say for now, Jacob doesn't count, doesn't get any of those things. Doesn't have any other taxes, right? None of this stuff really applies to him because he's very simple. He didn't make any extra payments, nothing exciting. No miscellaneous forms, no miscellaneous forms. Yes. Oops. Actually, oops, I went the wrong way. Go back. Back. Oh, I think I broke it. See if I can go back here. No, there we go. I'm missing a back button there. I can't do a state return. There we go. Jacob's return is done. So just like that. Not just like that, but anyway. Right, so we've got his name, his address, social security number. He's single. He has $5,200 of wages. Right, his standard deduction is his earned income plus that $450, so $5,650. His taxable income is zero. He owes no tax. He had $180 taken out. He gets all of his money back. And the software did it for us, right? We didn't have to do anything except enter the information on the return. So it is a very simple return, but at least some of our clients will be very simple returns. Okay. Any questions on that? I think I saw a question in the chat. Oh, we have to leave. Okay, no worries. Okay. So we're a few minutes late, but it's not horrible. I know that that was really fast. So this link is wrong as well, but you should be invited to the Moodle course. If you haven't already, make sure you sign up for that. You will have Moodle modules 1 to 3 that you should have already done. Module 4 is going to be an income quiz. Module 5 is going to be an adjustments and deductions quiz, okay? So we're not going to do any returns yet. We're going to do some practice returns after next week. And with that, that is everything for tonight. Thank you so much for coming. If you have any questions,